What is the difference between FHA and conventional loans? That's what we're talking about today. Nice to see you. I'm Esphir Popilevsky with Supreme Home Sale. And today it's all about mortgages. And after you're done watching this video, it's going to be very hard to fool you when you need financing for a home. So I invited Mark Tipis from Contour Bank to help us answer all questions about mortgages, FHA, conventional loans, MI, PMI, low down payment, this down payment. Anyways, stick around, subscribe to my channel, watch till the end so you don't miss anything. And the first question we're answering today is, what's the difference between a mortgage broker and a direct lender?
The difference would be the other side is a broker, right? Who's not a direct lender, who will then charge a fee that the client has to pay out of their pocket to do the loan. Whereas with us, with a direct lender, the bank is paying our fee for doing the loan.
So would that be fair to say that by doing it this way, the client will save some fees on their mortgage?
Correct. So it would be cheaper for a client in most cases because we're not charging upfront fees and the client's not paying for the service, but the bank is paying for the work of originating the loan.
Okay. So if we want to say to our client, you should use a direct lender or Contour Bank in that situation, what can we say? Well, what kind of average savings they can expect?
I mean, it depends on the mortgage broker you work with, right? So some mortgage brokers can charge a point, 2 points to do the deal. And then based on the loan amount, right? So, if you have a $500,000 loan amount, it's $5,000 to $10,000.
Okay, that's cool. Everybody would want to know, any programs specifically for first-time home buyers?
Yes. So we're doing all low down payment programs. So I can go as low as 3.5% down. FHA as low as 3.5% down. Conventional, we're doing 10-15% down. And then we're doing actually a training now. We'll be able to offer grants within the next couple of weeks where some of our clients can get up to $40,000 in grant money. So that helps towards the down payment. It sits as a secondary loan that they'll have on their credit report that they'll be paying, but it can help with someone who doesn't have the funds for a down payment.
Wait a minute.
Yep.
So the grant is a loan?
So a grant is a loan, which you're paying back, but the grant is like a secondary mortgage on the purchase.
Okay.
So it's up to $40,000 that gets lended out to the client.
And
depending on income and credit score and the deal size and so on and so forth.
Okay. So that's not a government grant.
It's not a government grant.
So who gives that grant? You guys do, or?
No, it's like city state grants.
So you said 10, 15 could be conventional, not 5.
Not 5.
Okay.
5 in very the problem is that these programs change, right? Like you can say 5, but then when you put it into the when you put the deal together, there's no lenders that are willing to take that 5% loan amount. So like even with credit scores now, right? We used to be able to do 580, 600 credit scores. Now they're not taking the 600 credit scores. There's no one on the secondary market that is willing to purchase a loan with a 600 credit score.
So who's an ideal candidate for like a conventional and an FHA?
So FHA obviously is for lower income, lower down payment type loans. So we can go as low as roughly 620 credit score now. 3.5% down. We can do front end DTI, right, which is debt to income. We can go up to 49%. and then back end we can go up to 55%, right? That's FHA. Obviously, the client on FHA loans cannot have any defaults on government loans. So a good candidate for an FHA loan cannot be in default on any educational loans or any other government loans that they have. And then conventional, a good client is 640 credit score and up, 10% down and up. And then we can do like, there's a difference between PMI and MI, which I think you asked later on. But with the conventional loans, sometimes 10, 15% down, we're doing a MI one pay, which means they pay for their mortgage insurance up to 20% in one shot at the closing. So we're going to talk about this later, but I guess we'll kind of go back and forth. So PMI is property mortgage insurance, right? So on FHA loans, it stays forever, right? You will have PMI for the life of an FHA loan. With conventional loans, MI, in conventional loans, it's MI, mortgage insurance. It falls off after 20%. So if you purchase the property for $500,000, right? At $400,000, that MI falls off on its own. The bank removes the MI. What we can do on certain conventional loans is, and with certain clients, is they pay the MI, that payment that they would have made until they reach 20%, upfront at the closing. And this way, it doesn't affect their income, it doesn't affect their DTI, and they can qualify for potentially a larger price property, a higher price property.
But why would they do that? They can just put it towards down payment and don't get PMI at all.
It depends on the situations, right? So sometimes they don't have it, right? They'll only have the 15%.
Yeah.
Sometimes there's so many reasons why somebody doesn't have the 20%, right?
No, but I mean, instead of paying off those,
MI, it's not that expensive.
It's
So
not.
if you look at, let's say, another 5% of, let's say, 500,000, just for speaking sake, right? You're talking about 25,000 on the same loan. MI would be roughly $5,000.
So just add another 5,000.
Correct. Instead of paying another $20,000 or putting another $20,000 down. So for somebody who's cash strapped or only wants to put X amount, but wants to go conventional and has issues with income, right? Because MI it's a payment every single month. We can do one pay up front. They pay the whole MI up until they were 20% in, and then it doesn't affect their income, and they can purchase with 15%, 10% down.
Okay, but then you have other people who have a higher down payment, but they will still have to do FHA because of.
Yes, I mean, depending on their income requirements, right? Depending on if we can fit them within, because with those types of loans, you can only do 49%, right? DTI. With FHA loans, you can go up to 55% DTI on the back end, which means that they can use more of their income towards the purchase of the property.
What are the major differences between a conventional and FHA loan?
So FHA is going to allow for lower income, lower down payment, and lower debt to income ratios, right? So a person who has a lower credit score or not enough income or not enough of a down payment would most likely typically go towards FHA. FHA loans are also more expensive. They're government-backed loans that tend to have a little bit higher rates, a little bit higher closing costs, and PMI never comes off unless you refinance the loan. So that's really the big differences between a conventional loan and an FHA loan.
Okay, so do you have like a number, like a credit score number that's only going like, that's gonna put you in a FHA regardless of everything, all the other
620.
620.
You're not getting a conventional loan with a 620
And if you
mortgage.
have $1 million.
It doesn't matter.
Okay.
If you want to fix your credit, I have a video out there that you can watch next.
We do no income verification loans, right?
Oh, cool.
Yeah. So I do no income verification, right? But no income verification, you need a 740 credit score.
Mm.
You need 25% down plus closing costs.
Okay.
Um,
But what are you gonna do? You're gonna do bank deposits, like statements?
you get a letter from your CPA showing that your business is in good standing. If you're self-employed, business is over 2 years old. CPA writes a letter. I have a template that I send to that client to get their CPA to put it together. They state that the business is functioning, no losses, income generating. If you are employed, we do a verification of employment with no income on the verification. So we don't ask how much you make, but we verify that you have a job. So it's really a case by case basis.
Just a short explanation of what is a PMI,
Mhm.
and can you get out of PMI, and so when and how? So what is it?
So anytime you are purchasing a home with less than 20% down, whether it's FHA or conventional, you are paying an insurance into a pot of money that will then be dispersed to any homes that go in default. So you're paying an insurance towards the potential default of any of the homes that are less than 20% down. With FHA, it's called PMI. With conventional loans, it's just MI. With FHA loans, the PMI never comes off the loan unless the person refinances at 20%, once they've paid down 20% of the equity. With conventional loans, once you hit 20%, the bank will remove MI off of your loan. So you're no longer paying the MI.
So the MI, does it go to the same pot or is it a different pot?
No, no. PMI goes to one pot that the federal government holds.
Right.
And MI is actually a mortgage insurance that goes to an insurance company that will insure the loan in case anything happens. Doesn't matter. So for FHA loans, they collect all of the PMI into a, let's just call it one checking account, right? And then for any defaulted loans, they will use that to pay the defaulted loan to themselves. It protects the government from these defaulted loans.
So in other words, the government promised the bank, you lend these people money and we're going to back you up.
Yes.
We're going to collect some premium from these people, like
Correct.
unemployment insurance, for example.
Correct.
And then if they default, we'll pay you whatever they owe you, but they're screwed anyway. They're going to be foreclosed on.
Doesn't matter for them. They're not getting anything.
Explanation.
Yeah, that's a perfect explanation.
In simple terms.
If you'd like to get in touch with Mark Tzipis, you can comment below or give me a call at 917-579-4455 and I will connect you to Mark directly. And thanks for watching.